Hey, it's Michael Tiny Soul back again. This is part two of money management for wild times. So, how are you adjusting for wild times? Now, by wild times, I mean an increase in volatility like we saw the week of August 1st, 2011. Right now, as I'm starting part two, the futures have reopened, and on Friday the 5th, after the market closed, the U.S. Credit was downgraded by S&P, and the futures opened down about 30 points, ticked a little bit lower now. Looks like they're trying to stabilize. I don't know what's going to go on, but it looks like there could be another volatile week ahead of us. So how are you adjusting for the what I call the wild times, which is the big increase in volatility? Well, Sheldon Nanenberg, in his book Options Pricing and Volatility, said volatility is mean reverting. It's a great statement, very powerful when you think about it. Okay, periods of high volatility are followed by periods of low volatility, and vice versa. However, they don't just click on and off. Okay, so when volatility increases the way that we've seen it recently, it takes a little bit of time to wind down. So the chances are that the market can stay volatile for a little bit here. And by volatile, I mean have some nice ranges and have some nice volume. But, it's not always the best thing. Look, an increase in volatility equals an increase in opportunity. That's the bottom line, okay? With more volatility, there's a lot more opportunity to potentially take advantage of. But if you don't modify your plan, or if you don't have a separate plan for when the market is volatile, the volatility can really hurt you, okay? Now you have to decide, is your risk going to stay the same, or are you going to decrease it? Notice that increasing it is not really an option. Now, I know some people might be thinking, well, if there's an increase in opportunity, why would I want to decrease my risk? Well, there are going to be a lot more setups, which means you're going to have the opportunity to make more winning trades. But as a professional trader, you always have to look at the risk, okay? So since there will be more setups, there are more opportunities for you to have losing trades. Now, I don't want to get any emails from the positive thinkers. I'm all for the positive mindset, but the law of attraction does not work flat out in trading, right? You don't just sit there and try to attract money to your account, and that's what happens, all right? I'm not saying that you can't use the law of attraction for other things, but you can't just think it and your account is going to start flooding with money, all right? You have to always look at the downside. You have to always look at the risk, because risk is what we can control, all right? So there are going to be more setups. Now, if you go on a little bit of a losing streak, even a couple of losing trades in a row, do you want to be at full risk for those, for those losers? I mean, we talked about it in the last video about how you may want to decrease as you go on a losing streak and increase as you go on a winning streak. But what about starting out? You may want to start out at a lower risk. There's going to be less choppiness and more directional moves. Okay, so that means, when the market's choppy, sometimes you get to bail out as it forms a range. But when the market's overly volatile, there tends to be more directional movement. And if you're risking the same as you have been when the market hasn't been as volatile, all right, you put yourself in a dangerous situation if the trade goes against you and you're not using hard stops. Okay, so how do we reduce risk while taking advantage of the extra opportunities, right? We have to try to do both here. Well, the first thing is reduce size. Okay, by reducing size, you automatically cut your risk. So if you're a futures trader, you may want to cut the amount of contracts. If you're a stock trader, you may want to cut the amount of shares. Or if you're an options trader, you can also cut the amount of contracts that you're trading. The second thing you could do is you use profit targets as stop trails. So in my opinion, when you set up a trade, you should always be looking for a profit target. Now, I'm a big believer in letting the market take you out, but you should always have a general target of where you're looking for, because that helps get your risk-reward ratio. Okay, now, I'm not one of these, you have to have a 3-to-1 risk-reward ratio. That's not the way that I usually look at setups. Okay, I think you could be very profitable having a 1-for-1 risk reward ratio. But if you're having a half-for-1, which means you make 50 cents for every dollar you risk, you better be really, really, really good. So that's why you have to have some general profit targets. But when the market is showing an increase in volatility, it may not be a bad idea to use those profit targets as places to trail your stop losses. Now, I'm not a big believer in hitting profit targets and then letting the position turn into a loss, but there's nothing saying that you can't hit a profit target, move your stops to break even or higher, and then as it continues to move, continue to trail your stops up as appropriate. Now, overshoots are common in a very volatile market, and if you look at some of the charts, and we're going to look at a couple in a few seconds, you could see that overshoots of support and resistance are common, which means you have the opportunity, even though you may have reduced your size and may have reduced your risk, you have the opportunity to make up for that by the move going further than you're expecting it to go. Okay, so you always want to layer your support and resistance. You don't just want to have one support level and one resistance level. You want to go up to the next level and the next level and the next level, because you always want to see, if you get the overshoot, how what the next targets will be and how you can take advantage of that. So let's look at a gap fade. This is the gap fade from Friday the 5th. It is after the job numbers were released, and this is just a basic first bar fade that I've been teaching for years, and now some other people are teaching it, claiming it's their own, but that's fine. It's okay. I didn't mean to keep it as just my own, right? So here is the first candle you could see on that vertical dotted line, and then we look to short a breach of that first candle with a stop above the high of the first candle. And this is just a basic technique. Okay, I'm not saying that this is the perfect technique for this market. All I'm showing is one example. Okay, so you had the entry. The first target is half the gap fill. That's the cyan line. And the second target is the gap fill. But notice that after that, you get a full 1 point more on the SPY as the market overshoots that support. And then it comes back, and then it even goes lower. Okay, so that's why for something like a gap fade, you may want to use first and second targets as areas to trail your stops. Now, here's just an example. Like I said, you have to do your own trading plan with this, but let's say you usually take half off at your first target, and then you take the rest off at the second target. Maybe you adjust it that at the first target, you want to trail your stops up, and then at the second target is where you want to take half off, and then you want to look if there's any overshoot to maybe cover the rest, or if it's a gap fade the other way, right? If it's a buying gap fade, a long side gap fade. So maybe you want to look for an overshoot of resistance, an overshoot of the gap fade to the upside. So just something to keep in mind as you're laying out your trades. Okay, now here's another pattern. This is a head and shoulders pattern. This is on the 1 minute chart. And you could see that the neckline is sloping to the downside, which doesn't always make the greatest head and shoulders, but in volatile markets, these kind of patterns can be powerful nevertheless. So this is a reversal pattern. The entry and then the stop loss is a 40-cent risk with a 51-cent target. Like I said, just a little bit over 1 to 1. Okay, what's that, 1 1/4 to 1 or whatever it is. And you can see it fires off. Okay, it fires off to the downside, and then it comes back up, does not stop out, and then hits the first target, and then hits 2 times the target, and then hits 3 times the target. Now, what's the target? On the head and shoulders, you just want to measure the neckline to the top of the head. So you got the first target hit, okay, then you got 2 times that target and 3 times that target. So if you were just moving stops, or maybe taking a piece and then trailing stops and then letting it go, you could see that the 40-cent risk becomes $1.53 at 3 times the target. You're almost at 4 to 1. All right, so this is just what volatile markets are capable of. Will all your trades go way past the initial targets? Absolutely not. This is just one option that you may want to put into your trading. Okay, you may want to take profits, or you may want to trail your stops, and then you may want to try to squeeze as much as you can out of the sponge, right? That's what I say. You wring as much water as you can out of the sponge. So I hope you enjoyed this presentation. Feel free to contact me at tinymjs@gmail.com. And if you provide your phone number, I will call you and give you 15 minutes of free coaching, no strings attached. You can ask me whatever you want. If you're looking for assistance with designing a trading business plan, or if you just want to ask me some questions, that's fine. Don't call me up and ask me for advice. What should I do? I'm down. I don't know what to do. I'm stuck in a position, because I can't help you. I'm not a financial advisor, okay? But I can help you with strategies and tactics and designing a trading plan. Just email me, leave your phone number, and I will be happy to give you a call. Take care. Hope you enjoyed the presentation, and I will talk to everybody soon.